Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Thanks for joining me for this month's market update. Today, I'd like to focus on two themes driving markets right now. First, we'll look at the macro backdrop, how inflation and energy prices are changing Federal Reserve expectations and potentially impacting corporate profitability. Then we'll turn to what remains the dominant investment story of this cycle, the continuing evolution of the AI trade, and how leadership within that theme has been rotating, and what might come next. So let's get started. As we move through the end of July, the S&P 500 is up roughly 9.6% year-to-date, putting the index on pace to exceed its long-term average annual return in just over half a year. Throughout 26, markets have navigated geopolitical volatility, shifting inflation data, and changing expectations for monetary policy, all while continuing to push higher. While the headline return is impressive, it's always what's driving those returns beneath the surface that I find more interesting. One of the most important drivers of investor sentiment this summer has been around inflation. This month, the June inflation report showed a meaningful cooling in headline consumer prices. Headline CPI actually declined by 0.4% month over month, bringing the annual inflation rate down to 3.5% from 4.2% in May. While consumer inflation softened, producer inflation remained much stickier. Core producer prices continued running above 5% year over year, indicating that many businesses are still facing elevated input costs. The gap between these two measures is worth watching. If companies absorb higher costs rather than passing them along to consumers, that may look positive for the inflation prints, but it can pressure corporate profit margins over time. As we move through earnings season, we'll be watching closely for signs of margin compression, particularly in those consumer-facing industries. Another key factor behind both inflation and market volatility remains energy. Oil prices have continued to swing alongside developments in the Iran conflict. Earlier declines in crude prices provided a tailwind for the inflation data I just covered, but renewed tensions have now pushed prices higher again. As the conflict drags on, inflation readings may continue to fluctuate from month to month. That makes it harder for policymakers and investors to read the underlying trend. Which brings us to the Federal Reserve. While many investors naturally focus on the 10-year Treasury yield, it's the 2-year Treasury that often provides the best view of changing expectations for Fed policy. Following the June Fed meeting, investors began pricing in a more cautious path for interest rates. That's because new Fed Chair Kevin Warsh has made inflation control the centerpiece of his message since taking office, recently telling Congress the Fed has no tolerance for persistently elevated inflation. We just covered how underlying price pressures are still sticky and energy markets are adding uncertainty. So that stance has reinforced the view that rates may stay elevated longer than many expected earlier in the year. And you can see here the impact it has had as the 2-year Treasury yield has shifted higher as markets reassess the likelihood of the Fed actually hiking rates this year versus earlier expectations that we would see them cutting rates just a few months ago. For equity investors, the implication is straightforward. A higher for longer rate environment places greater emphasis on earnings growth and overall fundamentals. Companies will need to keep delivering results to justify current valuations. And that leads into our next topic, the evolution of the AI trade. Despite all the news about market broadening, the AI theme remains the single most important driver of both market performance and capital investment. What's changing is where investors are finding the greatest opportunities within that theme. Earlier in the AI cycle, market leadership was concentrated among the hyperscalers and the so-called Magnificent Seven. Investors focused primarily on the companies that were building and deploying these AI platforms. This year, leadership has shifted toward the infrastructure layer supporting AI adoption. Semiconductor manufacturers, memory producers, and other companies supplying the hardware needed to power the next phase of growth. In many ways, investor attention has moved from the applications of AI toward the infrastructure required to make those applications possible. At the same time, You may have seen a narrative out there that has emerged suggesting market leadership is broadening significantly beyond technology. Now, there's some truth to that, but let's take a closer look. You can see here that energy has dominated results this year for obvious reasons tied to the conflict in Iran, and tech is not far behind. While there are several other sectors posting solid numbers this year, many of those still maintain deep connections to the AI investment cycle. Industrial companies like Caterpillar have benefited from data center construction and infrastructure spending. Utilities are seeing increased attention due to the growing power requirements from these AI workloads, and even parts of the materials sector are benefiting from the broader build-out. So while leadership may be spreading from the Mag 7 out across some other sectors, the underlying driver remains consistent. It's much more of a rotation of this same AI theme being expressed through a wider range of industries. For now, that is certain names really benefiting as they find themselves at the center of the AI story. But we want to caution how quickly things could rotate within this theme to the next bottleneck or area of value creation within AI. Another development in this cycle worth watching is how it's being financed. We started with many of these hyperscalers, Amazon, Microsoft, Alphabet, Meta, and Oracle, using mostly cash on hand to build out these projects. But this year we've seen a shift to using the debt markets to help fund them instead. This group of five have issued almost $200 billion of bonds this year, nearly double what they did for the full year 2025. And adding other debt structures to the mix pushes these totals significantly higher. This isn't necessarily a glaring red flag on its own. These are still companies with tremendous balance sheets, and they continue to generate significant cash flows. But it does create a new channel through which investors can evaluate the health of the AI investment cycle. Going forward, confidence in the AI story won't be reflected only in stock prices. It will increasingly show up in credit markets as well, and we're already seeing early signs of investor pushback as this issuance accelerates. For that reason, we'll be watching both equity performance and credit conditions as important indicators of the sustainability of AI-related spending. All of that spending eventually has to turn into revenue, and it's still a question of when that will come for these companies. To summarize, markets continue to benefit from moderating inflation and resilient earnings, but investors are adjusting to a Federal Reserve that appears committed to keeping policy restrictive until inflation is firmly under control. At the same time, the AI trade remains the dominant force shaping market performance. Leadership has expanded beyond the Mag 7 into semiconductors, infrastructure, and even industrials. But the common thread remains continued investment in AI capabilities and the infrastructure that supports them. As we move through the second half of the year, we'll be closely monitoring inflation trends, corporate margins, Fed policy, and the evolution of AI spending as the key drivers of market performance. Thank you for watching, and we'll see you next month.